Economy good, capital markets so bad. If you're a multifamily investor, active passive, you're someone that's in the industry, this is the YouTube show podcast. It's designed especially to help keep you up to date, right up to speed on everything that's going on in the multifamily industry, commercial real estate, housing, general macro economy. Join you every week by producer Dr. Matt Bosnagel, and Director of Communications and Marketing here at Great Capital. Incredible reports. CoreLogic, RealPage, Newmark, Cushman & Wakefield, Rent Cafe, MSCI. Again, housing looks great. The economy is looking maybe too strong. Capital markets, not so much. And maybe we've got some steeper waves up ahead of us. We're going to break down into every aspect, every nook and cranny of these reports. Stick around for the whole episode. Let's get into it. Welcome back to the report. Thank you again for joining us on a beautiful summer day. Matt, thanks for being here once again. Great set of reports put together. As simple as I was asking her before we started, what's the theme? Economy good, housing good, looking much better than expected. Capital markets, financing, any of this good looking stuff, not looking too good or easy. Interest rates have gone kind of the opposite direction. Maybe some of this has to do with the whole debt ceiling debate and debacle that maybe looks like we're getting ourselves through. Maybe I don't know. It's always kind of discounted, optimistic. But they always figure it out. It's all rhetoric. Sure. I mean, if you're going to negotiate, you have to take an extreme position. If you had a bunch of whether you're a congressional Democrat or Republicans or the president, if you bring on a consulting expert on negotiating, they're going to tell you to keep those anchors so low and be extreme and use the fringe members of your party, whichever side, to get as much as possible.
It's hard to not interpret. I'm not going to name names, but some of these names was like, wait, you were reasonable yesterday, and now you're like not being reasonable. I think they're just waiting because also the closer you are to the debt, We've been through this too. Closer you are to the deadline, the more leverage can be.
Time squeeze. You got to get a decision and then it's who's going to face the blame, and everyone would. But that blame can be moved around pretty tactically by the media. And those. So there's a little bit of that I think that may just be a little transient that we're moving through, but it's not making things any easier, especially with people who were hoping to maybe refinance at the end of this year. Or this year. Or looking to buy something. It was a couple weeks ago, Matt, that, the 10-year treasury was, hovering around like 3.4%. You could get some good agency debt in the low 5% range. Even saw some quotes, lower leverage, in the 4.9% range. Wow. Stuff that's looks really starting to look very attractive. But, with the 10-year moving back up, that's no longer the case. So, again, these capital markets are being frustrated. Why don't we dig into this CoreLogic report? I'd love to get your take. They always put out some really interesting stuff. What say you, Matt?
Let's do it. So housing is up. And while it's not up by much, I think it's measurably good for apartment investors. And I think it represents a shift from previous months of negative growth. The small gain in March is the year-over-year number, so it's up 0.7% from last year. And if you look at the chart, it's very, very easy to see how much momentum was and really still is pushing home price growth into the negative in terms of annual numbers. We could see future months of negative year-over-year, and you look at this chart, there's already for some, according to some of their measurements, whether it's like the 10 city or 20 city average or whatever their grouping is, they have negative numbers for some of their indices, but their real national average is still 0.7, which is positive. Again, you'll see this and you'll see it falling off a cliff. I think the month over month numbers tell a different story because, could actually be negative, but as is the case with apartment rents during this period of transition, it's much more useful to look at the monthly numbers. And the month over month is positive. They used to be negative. If you look at this chart now, I'm going to jump right into RealPage here in a second because
let's do that.
They have a much more revealing chart. It really compares year over year and month over month. That's all I wanted to see. and God bless CoreLogic. They've got a lot of good information about specific markets, specifically how Chicago has rebounded. But I want to know year over year and month over month how that relates to each other. Now, this is the real story. You look at the year over year, going down, still going down, but the month over month.
Yeah, what's that, Matt? It's some crossing of lines there. I think a technician may say that means something.
And I think it's easy to see the month over month, the small, because the month over month right now for listeners, the month over month is this bumpy, a little bump on the ground. And the real hill is the annual. But I'm telling you that the fluctuation that you see around March of 2022, as that went down and it stayed down into the negatives really from June of 2022 to let's see, what was it? February of this year, February, March. That period is going to result. That's what's driven this decline of annual prices. Yeah. So we're fighting against really almost a whole year of negative price growth, monthly price growth. Now we're just beginning to see positive price growth. I think this is definitely a case where the story and the trend and the new thing that's happening is that home prices are going up a little bit, but you're going to see negative headline numbers that I don't think people should pay attention to.
It's what narrative do you want to be pushing? I think the reality, though, and I think that for those who are covering this, as unbiased as they can be, and really regardless of what your motivation is, the housing sector is holding up much better than most would have anticipated. Mm-hmm. Most would have anticipated by now, with interest rates being as high as they are and for so long, because it takes time for the higher interest rates to really kind of seep into like the real economy, you would see deeper price discounts. But in reality, maybe we've seen some declines, but if we're seeing maybe ticked back up and, a relatively, hot housing market, or at least a moderate housing market. Yeah. And again, these slight losses or these slight gains are compounding off the incredible growth a couple of years ago. So it's not like we're seeing double digit, price drops, at all. So we're just barely adjusting off the huge increases in the values of those single family homes. Yeah. But the true price or the cost to own one has gone up so much more than just like the underlying value of what your monthly mortgage payment is. That's what's still staying up there. Mm-hmm. And that we would have thought that would have started bringing those prices down, but it just hasn't. It just hasn't. And again, that it goes to show. We can talk about how rocky the economy is, and we may be on the edge of a cliff, and there could be waves, and all those things, can easily be true. But we also should acknowledge that there are areas of the economy that are doing, are very strong. Yeah. Now, is that like the last burst of energy before something? Yeah. Easily could be. Mm-hmm. A lot of these indicators are lagging. There's strong jobs reports. That came out today.
I saw that too.
Strong hiring. Mm-hmm. Job numbers are looking good. But again, those are all lagging indicators. If something happens, we're not looking at what the jobs were before something happened. It's, it's after and in the future. So there's a lot to be happy about that. At least we're doing as well as we are right now. Yeah. Conversely, though, it's frustrating for the Federal Reserve because they're waiting to see it. They want inflation to be brought down. They're waiting to see housing come down in wages as a way to kind of just pour water on the, the coals of the economy. But they're not seeing, they're pouring water on, but, water's evaporating. It's too hot.
Yeah. Yeah. That's what makes me nervous. It's like, I feel bad being optimistic, but I do think almost independent of the economic anxiety that that still is present, but maybe in a slightly smaller form, but people are still anxious about recession. That's still on the tip of everyone's tongue. Housing demand, though, seems to be just pushing right through inflation and mortgage rates and all this stuff. I do think it does redound to the benefit of the apartment market if even in this elevated mortgage rate environment, people are still pursuing buying a house.
The desire. Well, one, again, it's a need. Mm-hmm. We can shelter as just a necessity for life. And then if people are in a position where they can, they're not thinking about it as an investment, as buying the top of the market. They're looking at it from their quality of life standpoint. Mm-hmm. I know that I'm going to be paying a high interest rate. Maybe I can refinance later, maybe not. But this is what I want for myself and my family. And we can make it work and we can afford it. Let's do it. Yeah. I think the surprising thing to a lot of people is that there's some people that can afford it and they can do it. Yeah. Wages have been rising, which is, good for the housing market.
Yeah.
Rentals or for sale.
So I think that these are good signs. It is, but if it's a sign of anything, I think it may be a sign that interest rates could remain higher for longer. There's not, maybe, I don't know. It's like these are the prices that a lot of things that they're attuned to, and I don't see any reason why they would
if prices aren't without some additional catalyst. What is going to push prices lower now? I mean, there's not because there are enough buyers coming to meet the few sellers, and there are fewer sellers than there ever have been before. Because so many people have locked, especially talking single family homes. So many people locked in a low interest rate. You're not going to get me to move. I bought the house that I wanted. Even if you I don't love this house, it's hard to justify and selling and moving right now. Again, unless you really
and home builder confidence is up too. Yeah. And that's really responsive to where they think where housing demand might be, because if supply is low enough, if they're confident, because it used to be supply was low and they weren't so confident, but now that demand is kind of starting to pick up, they're feeling a little better.
It's a push for household formation because people are forming families, or they've started to form a family, and they're like, we need to get in that people are listening to their internal bodily clocks. They're thinking about their family. They're thinking about where they see themselves now and in the next couple of years. And when you're thinking about settling down and getting married and having kids, which is what the median age folks in the early mid-30s are thinking about doing. They're like, I need to get ourselves set up. We need some stability. I don't want to be moving around. I've jumped around, rentals for the past couple of years. I want to sign, either want to buy a house I can stay in for a long time, or I want to rent. I want to move and rent somewhere that I can stay in for a long time. That we got the room that I can see ourselves growing into. Yeah. And that desire for that life, I think, is much more important than looking at an ROI and looking at it as an investment, which is why we've said, and many other people have said, you never look at your house as an investment, or really even as an asset, even though it totally technically can be an asset. It's much more of a liability, and it's more of just it's like what kind of car you want and what kind of clothes you're going to wear. Yeah. You can get from A to B in the bus or on a bike. But, a nice, SUV is, a fun way to do it. It's comfortable. It certainly isn't necessary. Yeah. Same thing with close. Same with housing. You have to live somewhere. You have to have shelter. But then when it's I want a certain lifestyle, that's being prioritized. Yeah. And, again, the experiences over things, even though a house is a thing, it's also an experience. It's you're going to experience every single day. Yeah. And I think that is overriding is this a good financial decision? I don't think people really care.
Well, I think it leads into the next Rent Cafe article.
Let's go.
The rise of build to rent. Maybe not. Maybe you're not buying it, but maybe you do want to live in a house. You do have kids. You want a yard, maybe, or you want a home, 4 walls. You don't share a wall with anyone. Maybe you go build to rent. Yeah. And the big headline here is that it's 3 times, what does this say? New build to rent hit record with 3 times as many houses under construction. 3 times as many as what? Well, they don't say it in the headline, but they do in the article.
Well, for reference, I think the first BTR build to rent community was in Indiana, was sold not that long ago. So it's such a new asset class. It's been going on for in the Sun Belt, in other markets. And obviously people have been buying and renting single family homes for a long time and putting them in areas next to each other. And I've got a couple houses on a block. So it's not a true new concept, but the way of thinking about it as its unique strategy of this thing right here that we're going to build. These homes are going to be, we're going to build the house to rent. We're usually single family
neighborhood. Yeah,
exactly.
I think that, okay. So this 3 times is actually, so compared to all of the build to rents that were completed last year, there are now 3 times as many build to rents under construction. These are homes, houses. Again, the point is they're building a lot of them, and specifically they're building these planned subdivisions and not just one-off homes in established neighborhoods. Now, I think what's kind of interesting, I've heard headlines that actually investment in these one-off home, investment in single-family homes in general is down. Yeah. But this build to rent seems like if there's all these under construction, then that's up. Yeah. I think the interesting thing is is like, I'm interested in, you talked a lot about lifestyle and about how you're going in there because you have kind of certain expectations. And I think that when I think of build to rent, and this is just my own stereotype, it's a negative stereotype of a bunch of beige cookie cutter single story houses around a retention pond, and there's not a whole lot of variety. Maybe you get a yard, maybe you don't. But that is and I think that there's a real space here for some innovation, for some kind of design and landscaping, really some attention paid to. You go in, you have a more welcoming feel than really just like a block of houses that all look the same.
Yeah. I think the same criticism applies to like most like subdivisions. There are some that are pretty like bare bones of vanilla, and maybe some, and I mean, some people I think like that, to be honest.
Yeah. And some people don't
frills, and some people don't care.
Yeah.
If you're moving your, elderly parent, elderly parent, downsizing, you're looking for low maintenance as possible. Maybe that is exactly what is right for you. But I think that conversely, there is a big demand for just the reason for a lot of amenities, nice landscaping, all the things that we've been doing on high end luxury A-class apartment communities.
Yeah.
It's you think about, and this is the difference between build to rent now and where it's going versus just like some single family homes.
Yeah.
And it's where some subdivisions have gone also, of having, community centers, like a garden style suburban apartment community has a community center with a community pool and nice fitness and, some community space and, maybe just some more community amenities.
Yeah.
I think there's a wide range. It's all going to be on a little bit of the higher end because the rent price point is going to be a little more expensive than, a 2-bedroom apartment. But I think that there is certainly demand for a very, very high end of what you would more get in a like luxury single family home. And I think there's going to be, and this is the concern, is that some of these homes are going to be built, relatively cheaply. Yeah. Because you don't have that buyer, that owner occupant that's going to be like doing that last walkthrough. I mean, you hear horror stories of just, for sale, but, for the homes that people are going to live in. Some of these builders that are, putting up thousands of homes, the build quality can be really bad. Now imagine you don't actually have an owner who cares. You got a project manager who's supposed to be managing, the building of 20 or 40 or 100 of these homes. Yeah. Is everything going to be, done at a high quality? I think that's a big question on some of these communities. How well were they actually built? What is the maintenance going to look like? And that therein lies a little bit of a challenge and risk to investors. While I think it's a great concept, something that we're leaning into heavily, what are the differences in management? Like what does maintenance look like? Because, on traditional multifamily, one of the advantages is, well, instead of, 100 roofs, I've got, 10 roofs or so, or 5 roofs, versus now I'm going back to 100 roofs. Now, but they're all in the same area. So, but it's a lot more roofs to fix.
I don't know if the market's been mature enough for there to be like a real cycle of you build this and then it gets sold off. The guy has to fix the next, the next person fixes
not
it.
one.
They haven't gotten to the part where, maybe the next owner has taken over. And so I don't know how much. It's got to be a consideration. Obviously, they don't want these things to fall down and they have maybe an exit.
Yeah, no, the CapEx print. It's all very similar, but it's just a little bit different. That it's going to take some tweaking, and it's more than doable. Yeah, and it's not, if you manage apartment communities already, it's not that hard to wrap your head around. But it's just different, and there's going to be better ways to do it and best practices that still need to be developed.
To me, it seems like land is would be this huge consideration. You've got to find a much bigger plot of land, and I was just looking at pictures too, and some of them are big houses that really dominate the lot, and it's one after the other, and there's like no yard.
Zero lot line.
But then other ones, they're a lot of smaller houses with big yards. But I think that the attention to you got to get the space for everyone and kind of organize it in a good way that makes money, but also making it meaningful, because every space that all the square footage that you're dedicating to a community center or even a retention pond, that's a place where a house could go. So you've got to make that balance, and it probably is going to be more expensive to cut all that grass and to do all the landscaping.
Exactly. And some of those zero lot line communities are they're very attractive, whether the managers cutting the lawn or the individual. You never usually want tenants cutting the lawn because they don't do it.
Yeah.
But it's regardless, it's less work.
Yeah.
A lot less upkeep, a lot less green space.
I mean, I don't want to live in the village of West Clay because it does seem like a strange neighborhood I'll never be able to find my way out of, but it looks so cool. That's too so there is a village of West Clay in Indianapolis, Indiana that's not built to rent, but it is a pre-planned community, I believe. Has a lot of variety of
it's a master plan development.
So and that's something that
with a mix of it's like townhomes, single family homes, apartments, condos, some retail sprinkled in here or there.
So
I mean I think it's a better option. I mean
it's a cool option, but sometimes I do feel a little Pleasantville when I go there.
Ooh, yeah, because that development, there's a lot of like architecture that looked like it was like designed in like the 1920s.
Yeah.
Like it was all brand new and if that was developed, because that was developed about 20 years ago, 25 years ago,
maybe
a little. I think so. They started, yeah. And I know time flies. Yeah. But if that was being built today, I think they would have a build to rent component. Of it. And again, that's what I see where I see this moving is these larger master plan developments where you're building a subdivision of where a certain amount of the unit or a certain couple acres are set aside for build to rent. And so if I'm a developer, it makes a lot of sense because I don't have to sell. So let's say I'm a developer, I'm going to develop, I don't know, 400 home sites.
Yeah.
Instead of selling all 400 homes to individuals or maybe, some lots off to builders, spec builders, I can sell a chunk of 50, 100 to, 150 off to one buyer that I can either sell, I know what I'm going to get for it, but I'll sell it on certificate of occupancy or as they're completed in phases. I've got it entitled and I sell them. You develop it, but this is where it's going to be. It's got to conform to the master plan development, or I take it all the way and I sell it big. Here's my 50 to 150 units. Just going to sell it as a block, and it's going to work into the part of the development, the community that the lead developers focus on.
I like that plan. Again, no, I don't mean any disrespect to villages, these master plan communities, because really they look beautiful. And some are better than others, and
but I think we're going to see there's a huge demand for people to live in a single family home.
Yeah.
Some people like apartments, some people like single family homes. It's certainly going to be not for everybody because there's going to be costs associated with it. Yeah. But again, following the demographic trends, people getting married, having kids, got a couple dogs, want some room, want some space. Yeah. You want to be able to have room for throw the water table out with the kids or, you got your backyard barbecue, your garden, whatever it is, like that life element. And in apartments, we've, tried to stay up on that of have a community garden, if I have all these amenities. Yeah. And that's always going to be the most cost-effective way to live with how unaffordable so many things are. There's going to be a lot of people that that's the only option. Yeah. And they don't care about a yard. There's always going to be some of those folks, but to a growing percentage, this build to rent is the sweet spot. Yeah. Don't have to have a down payment. Get everything you want about a house. Yeah. Don't have to mow the lawn.
And this is this is the answer to some of the questions that were underlying this housing demand. And there's enormous housing demand. People are still buying homes. Yeah. There is a low supply of homes. A lot of the solution should be, I think, build to rent, just because I think people will save money for the house for renting versus buying.
So you live in a build to rent deal, and then you invest with great capital if you're an accredited investor.
That's good.
And so instead of who knows, you're gonna if you would have bought that house, you probably would have overpaid. You weren't paying attention. Yep. Who knows? It's going to depreciate. You have to put money into it. You're going to be putting in $10,000 plus a year. Yep. Or you could just rent. You know exactly what your cost is. Plus utilities. You throw that, $100,000 that you saved up, you throw it to great capital and you're a accredited investor, and that turns into over 3 years, $300,000, 3x it.
That's a really good, lease. That's a really good leasing strategy. Just tell people,
don't buy.
Thinking about buying a home. Let me get out my calculator.
It's like you had the idea, and again, people are like, well, people build so much wealth because they buy homes. It's not because they're investing in a house. It's because they're finally getting invested. They've got this cash set aside and they're finally making a large investment. And you could say you make that a large investment in the stock market. You could say you can make it in real estate. If you're invested in the stock market, you want to invest it in, probably an index fund makes sense, or it's, a conservative strategy. You're going to invest in real estate, invest in the best real estate that's going to throw off cash and it's going to grow. And I've said this so many times, but like the chances of that real estate strategy that's going to throw off cash and grow lining up with the place that you want to live almost never coincide.
Yeah.
Like, again, are you making a mistake, and have you made a mistake because you bought a home? No, absolutely not. But I'm just saying we need to move away from if I want to grow wealth, I need to buy a house. It can be, I want to live in a house, but I'm going to think about my wealth growing opportunities as a separate conversation.
Yeah.
And if they happen to coincide, maybe that's great.
Yeah.
But if you separated the two, you may come to different conclusions.
Yeah, I think it'll be eye-opening, and it's not a thought that a lot of people have.
Yeah.
Put that money to a little bit better work than paying off a mortgage.
Yeah. It's like, people, borrow money from their parents or get gifts from their parents, for a down payment. So let's say it's, $50,000 or something. Throw that in, invest into a real estate investment that's focused on maximizing return and down risk mitigation. Or they're in the stock market, and again, a smart strategy into the stock market. People would be building wealth just as quickly, and maybe even quicker, because they're actually thinking about it as an investment, as opposed to accidentally building a wealth. I looked around and my house was actually worth a lot more. Look at that.
Yeah,
but I've also been putting money into so fascinating stuff.
Yeah, very interesting.
Do you want to move on to?
Yeah, totally. Let's talk about
market report. Let's talk about capital markets. Again, we talked about the economy doing so well. It's doing too damn well for Jay Powell. And that has been, some frustrating capital markets. Or they, they're still not cooperating with us, man.
Oh, no, they're not.
They're just, they don't want to cooperate. They want to be difficult. And Newmark has a nice summary and report for us.
Yeah, so right out of the gate, and I didn't really even, because they've got the summary. That's a wall of bullet points that really summarize where we're at. I've challenged myself here to distill this wall of bullet points even further.
Yeah, this is a lot of bullet points. This is what was on here first, Matt.
I know, that's why I said it, because it has a visual effect.
I didn't want to start everybody with just the wall of bullet points.
It's a little bit scary.
Are you ready?
But yeah, I want to run through these really quick. I've challenged myself to distill these
transitions, Matt.
Oh yeah, I like that. It's a classy fade,
right? Before it was this little just rough, just rough cut. That's fine. Anyway. Bullet points. Continue. We digress.
I get one of them's longer than the bullet points, but everything else here, I got a quick, short summary. So
are you going to go through all these bullet points?
I have them grouped into categories so we can dive in and dive out at our leisure. Okay. So first group is fundamentals. So the average multifamily rent's about $699 cheaper than the median home payment, which is just what we were talking about. Another aside, and so this is not in the Newmark report, but with 30-year mortgage rates hovering around 6.5, it hasn't been this high since the Great Recession, and that's I think that's really. Yeah, it's really interesting. It's almost generational, but definitely within people's financial memory is, people aren't used to this mortgage rate. So it's a little bit of uncharted waters.
Yeah, no, everyone has to, it's funny, but people's
parents maybe.
Exactly. It's so, how many times have you seen, Matt, people be like, well, my dad had a 8% mortgage, and we were happy to get it.
That's right.
We thanked the man.
Well, we
thanked him.
I've talked to someone that was like, well, I remember that, and I got it.
but we all, and that is true, and all things are relative. It's not historically necessarily the case.
Yeah.
Because those high mortgage rates,
it was defining
where we have today are 5% has been a good historic average for interest rate in general over past couple thousand years. But yeah, it's true. In the late 70s and early 80s, we had a huge blow up. If I can make anything work, here we go. Oh. But beautiful. So yeah. We're still low. these are mortgage rates compared. So we're at 6.39% today, Matt, compared to back in the mid 80s, 80, 81, where we peaked at 18%.
Wow.
Yeah, that's crazy. And this doesn't go back any further, which is frustrating. But I mean, we basically we're back. I mean, before that run up, we were in kind of in the mid 7% range.
Yeah.
And then since, call it 1987, we've been on a downward trend for a lot of different reasons. And this is the app. I still believe. And again, here, let's just go back to the 10-year treasury, because this will paint the picture a little bit more. Again, we have a long, so I mean, rates were mortgage. This is the 10-year treasury rate. All right. Which most 30-year mortgage rates are based on 30-year, on the 30, yeah, on the 10-year treasury.
Oh, okay.
And then there's typically a spread added on, or it's relative.
Okay.
You can see the spike, Matt, in the 80s and 70s. I mean, this is a relative aberration. Relative, again, if we go back even further, this is not typical. We've been on a long trend down. Now, are things going to go up for a little while? Like, absolutely, and stay up into this range? Absolutely is the case. But we haven't dealt with this, just the 10-year, for over a decade. And then, as to your point, mortgage rates. So let's go back to where we started.
Pretty much the same picture.
I mean, very similar picture, but I mean, yeah, we haven't hit this rate since. I mean, basically the 90s.
Now, I'm wondering if a little bit of the different movement of mortgage rates is due to, if there's not a lot of homes being bought, are banks incentivized to lower the mortgage rates just a little bit? Or is it basically just the 10-year?
I'm not an expert on 30-year mortgages, to be honest.
Yeah. Well, we were talking just before this about some of these places where like the 30-year mortgage will dip just a little bit, and you'll see from sources like, now it's time to buy your home now. And so there's a little bit of like magic and mystery to some of these mortgage rate fluctuations. But I think that the general story is that they're going down. But for as high as they are right now, the fact there still is demand is a really big statement to housing demand. Okay, so back to kind of the apartment fundamentals. The rents are $699 cheaper than the median home payment due to high mortgage rates, which we just covered. And also, the second bullet point is that after 3 consecutive quarters of negative apartment absorption, Q1 2023 saw positive numbers to the tune of 19,243 units, and demand is projected to keep increasing through the year at a level, quote, well above the average. I'm sorry, not just above the average, but well above the. So I think that is fantastic news. Again, still jibes with this increased demand. Bullet point 3, supply is up. It will see a large increase expected to reach nearly 550,000 in 2023 and an all-time high of 588 in 2024. Now, we have talked about this before. I think supply is open question.
Yeah, they never know.
Yeah, they especially
always overestimate supply.
Yeah,
it'll probably come on the opposite side, and they'll probably undercount it.
Yeah, I
agree.
Years, but so bullet point 4. So these are out of 11. Bullet point 4: vacancies have increased.
Through 11.
I can fly through so fast. Vacancies have increased, but at 5.2% quarterly and 4.4% trailing 12 months, we're still well below the 5.4% average. I think that vacancies are looking probably better lately than they were in late 2022.
So not only are you not summarizing, Matt, you are adding additional commentary to these bullet points.
I'm trying. I am tempted.
Just read the bold.
Oh yeah, that's actually true, because I had a big question.
They've done your work for you.
All right, so that's the fundamentals. Now loans, Q1 debt originations are down 55% year over year. Far less people are getting new loans. That's pretty easy to see why, because they're so high.
Let me try this next one.
Yeah.
Try this next one, Matt. Okay. Bank and debt fund maturities are heavily concentrated in 2023 to 2025. These are the loans most likely to encounter distress.
Okay, so this is the one that I couldn't understand. Bank and debt. So these bank and debt maturities are concentrated, but the government sponsored the GSE debt, the bulk of which comes due in the latter half of the decade. Then they say that this is like a very poorly worded bullet point, and you did the Lord's work in just summarizing it with the bold.
I didn't, but they did. I just read what they bolded.
Yeah, I know, but I read the words, and the words there's
You read too many words.
Yeah.
That less is more. The one piece though that could also be bolded is the 47% of securitized debt maturing in 23-24 have a DSCR of 1.5 or less. Now, this DSCR, may or may not be up to date relative, to current performance, but that basically means that they can cover their mortgage 1.5 times. So I can cover my mortgage, and then I've got basically 50% more of the mortgage payment available, or less.
And that's what the or less, because I've heard DSCR 1.5 is like not horrible.
No, 1.5 is good. Minimum's usually 1.25.
So, but the or less part makes me think that
that means they could all be one or none.
So, but the upshot to all of that is
they could have left this last. See, again, you were getting caught up in the too much information.
Follow the bold.
So, okay, let's try this one. You go just read the bold.
Sales volumes down 64.4% and 51.9% quarter over quarter. It's likely to remain subdued until values have adjusted to higher rates.
Yep, makes sense.
Can't do that.
Okay, I'll do the next one. Allocation to multifamily among U.S. commercial real estate declined from 40% in 2022 to 29.9% in the first quarter of 2023.
Okay, so
people are still investing in multifamily. That's the next thing to add.
Yeah, well, that's what. That's exactly. Either way, multifamily is still the tops when it comes to capital allocation. And my question was, if it went down from 40.2 to 29.9, that's a huge amount. I think that's new capital. I don't think that's existing capital has allocated from like multifamily to like industrial.
What are they? Where is it being allocated to? If not, because it's not like just in general.
Yeah, I don't.
Well, no, they're not. I guess it's not. To multifamily among U.S. commercial real estate. So that means relative to other commercial real estate, where it's typically 40%, it's down to 30%.
That seems like a very
where I guess I'm just curious where the money flowed to, if not to multifamily.
Yeah. There was a little bit of an open question, but
they're also basically saying it's kind of within the range.
Yeah.
So, okay, your turn, man.
All right, cap rates up 50 basis points since Q2 2022, moving in line with BAA corporate bond yield of 5.7.
Yep. Next one,
number 11.
This is it. This would be a great time to subscribe.
That's right. Hey, I think that the podcast, this is really doing well in the audio form.
Yeah. If people aren't banging their head against the wall. No, this is all good. These are all the facts, straight to your head. Although total returns fell into negative growth in the first quarter of 2023, income growth remains durable, as much of the slowdown returns came out of declining appreciation.
Yeah,
Matt, this is something we've been talking about quite a bit. And this is, again, just it's this shift. It's a shift away from more speculative growth investing and back to more value investing, focused on the reality and in-place cash flow and income relative to, cap rates are going to keep compressing and, I'm going to increase, revenue, but really just the market appreciation. Market appreciation is what's driven the vast majority of returns over the last couple of years. Again, if you were a great operator and did a great job operating a property, you got a great return. If you were a poor operator and ran the place almost into the ground and sold it, you still got a good return. So there wasn't a lot. It's difficult to separate between who's really doing a good job and who is just getting a good return because of appreciation. The market helped them out rather than actual operations. The focus is going to shift to buying right and operating right. Yeah. Which is, again, it's different from what we've been dealing with in the past. And so that last point was really good. Well, we've gone through all the bullet points, Matt. Does the report, other than some really nice charts and graphs, anything else to really pull I like from? They got some good graphs. They got good graphs. Should we show people until?
Yeah, totally.
What's your favorite one?
I like this graph of owning versus renting because it's something that comes up in
You're just talking about that.
Yeah, in other reports. There's a little bit of a dip in the cost of ownership. So the home prices seemed to have come down a little bit, but I still think there's such a gulf between these two numbers. It's way cheaper to rent than it is to own. And I almost wonder, is this really apples to apples? Now, they are comparing the median monthly home payment. So it's not like millionaires are skewing the average. So this is the median.
True.
I would love to know like a square foot, if you take equal square footage.
Yeah, because like single family homes are often bigger than an apartment.
Yeah.
That would make sense.
But I still think that you take one look at the still hot at home buying market, and compared to the rental market where rent growth is not growing as much as home prices have grown. So it's an easy answer. I just it would be interesting to see what other measurements.
If there's some way to equalize it, and maybe there's not a straightforward way to do that. Maybe doing it by a square footage of like at least trying to like compare.
And there may even be
similar square footages.
Yeah, there may be an easy way to do, like if we could find, so that if that's the median home payment, then we could find the median home square footage.
Yep.
And then the median apartment, then maybe we're there, but I'll do that next week.
I was gonna say it sounds like you're making some work for yourself.
Yeah.
And we should save this chart map. This is a good one.
Oh yeah.
Anything else? Shortage of new housing, particularly in the past decade, has amplified demand. We've talked about this a lot. I mean, in general, not just us, but ad nauseum. Of again, this the whole idea of we just didn't build enough housing over the last, really the last decade and a half or so post a great financial crisis. I mean, just like the decade averages were just it's rough. And multifamily has really started picking up, but not enough to fill the gap. Matt, any thoughts?
It's interesting to see. It's not there. Multifamily, especially even in the last few years when there was a lot of demand for apartments, it hasn't been like uniformly we're building. They'll build a lot and then they won't build as much, and then they'll build a lot and then they won't build as much. It seems like it's still
I mean, again, compared to the last couple of decades. I mean, there's a lot of building going on right now, but I mean, again, it still doesn't even compare to the last couple of decades. They're just the complete fall off between 2006 and till 12 till things just got started. And even in 2023, Q1 2023, we're not even back to 2004 levels or so.
Yeah, it's that's very weird.
Well, kind of 2003 levels. Which things started getting overheated, but we were in a completely different environment for many reasons.
Yeah, it looks like they really started to build a lot of apartments during the Great Recession. This lower line here, which represents the share of apartments versus single family home
total. Yeah,
it's it really came. So basically, from 1993 to 2007, there was less apartments being built. Period, and then it started
family homes
started ramping up, and that's still that's part of the equation here, and you can definitely see the fall off on total homes built. It really just falls off a cliff.
Yeah, that's pretty dramatic. But I do say so myself.
Yeah.
Any other graphs before we move on to there's a lot of great stuff in this report. It's a good report. I recommend you check it out. You can always check this stuff out by subscribing to the Gray Report newsletter. Hop on over to graycapitalllc.com/newsletter and get all these reports plus a lot more sent to your inbox. Twice a week, Matt. You get a full report on Thursday. Sunday, you get a quick update. What did you miss throughout the week? Man, I was told last week by an apartment owner.
Yeah.
They own about 27,000 apartment units.
Okay.
He said, your guys' newsletter is incredible. He's like, it is exactly what you need to be looking at and paying attention to. And he said, it's so hard to stay on top of it. You're so busy finding deals, managing your deals. He goes, that email comes in. It's like exactly what I need. This is is it. I've got the reports. Yeah. Which is exactly why we started doing it. You were like, there's all this great data that's out there and reports, but it's hard to find.
And we were talking about this yesterday. The real estate, commercial real estate, apartments specifically, a lot of people are writing a lot of things all the time.
Yeah.
It is one of the more prolific, one of them. People love to talk.
It's a big industry,
and they write a lot. There's a lot of publications that come on, and a lot of times you can fill up a newsletter with stuff that's maybe it's not like a great report, but you can give 50 articles a day. I'm sure a lot of it's going to be who bought and who sold stuff, but like you got to separate the wheat from the chaff, and that's what I try to do every week.
And if you're just doing it on your own, it's hard to separate, and then it's hard to find a lot of stuff. It's all siloed on different companies, websites, research reports. Some it's behind paywall. Some of it you just have to register. They're not sending emails out. That's why we started doing this because I kept finding reports that were old and stale. Yeah, and I was like, I didn't know this came out. This came out 2 months ago. Now it's old. Yeah. Not that it was worthless, but it would have been much more valuable a couple months earlier. So we started putting it all together, aggregating. Matt you do a great job every week.
Built up some kind of like spinal cord twitch reflex for like
people
finding the report, getting around the paywall.
Multiple times. People were like, I don't know how you guys do that. I'm like, well, fortunately, I don't do it as much. It's like
I've tried to get AI to do it. Yeah. It's not there quite yet, but it'll take my job. Yeah. Next week, probably.
Well, so hop on over to greatcapitalllc.com/newsletter to make sure you're signed up for that. And, while you're on the Great Capital website, check us out if you're a accredited investor. We'd love to have a conversation with you about all of this stuff and more. Matt, you want to move on to MSCI?
Now,
prices of all major U.S. property types fell in April.
This shouldn't be news to anyone. And this monthly update is always fairly short, but I always think it really just packs a punch because it's got this great graph where you see where the property values are. And that, perfectly is a reflection of the sluggish capital markets that we just talked about. Yeah. So for a headline summary, apartments are declining the most, declining 12.1% year over year compared to 9.4% fall for all CRE properties, a 6% descent for retail assets, a 6.9% drop for office, commercial real estate, and industrial properties sank by a scant 0.8%. I almost had to pull up the thesaurus for synonyms of dropping, sinking, falling, descending. Declining, I think I put in there.
Those are all good dissenting. Any other good ones?
I almost said dip, but I don't think that it is. It's fair to call it a dip. It is definitely a fall, drop. But here's the thing: on the most logical, straight ahead view of this is not great. This is less money for people who want to invest in these properties. Well, except for industrial properties, which are doing like pretty much just dandy. And even though you're supposed to keep your eyes on the horizon, look at the fundamentals, and not let price fluctuations distract you when you've got a long-term mindset. Yeah. I don't want to disregard the cold facts here, and they are cold, and I don't like it. This means less money for people.
Now, what's the sorry, Matt, not interview. What's their methodology on this when they're saying prices are declining? Is that an estimating of like fair value based on where cap rates are, or is that based on actual sales data and transactions? Is this where they're saying they think prices should be, where prices actually are based on transactions?
I'm guessing it's transactions.
That's a big difference.
Yeah, I would like to look at their methodologies, but whether it's an estimate based on where they expect things to go or a reflection of actual transactions that took place, it's not a surprise that this index
you're right. And I'm not saying it's wrong, but it would be. I just want to make sure we're talking about the same. Yeah, we're talking about the same thing because again, in order to have like a market to work and for there to know the price of something, to discover the price, and when we're not sure, there has to be like transactions. Yeah. And so let's say there's $1 trillion worth of commercial real estate out there, and one transaction takes place, and let's say it's for 6 cap, and that's a 20% discount to what the market was. Is everything valued? Yeah. Well, that's at least a data point. So unless there's another transaction, I can say like, that's where the market is. That is a data point. Yeah. But it's enough to say that everything is priced that way. I'm not sure. But what's been happening is has there been some distress and some discounted sales? Like, yes. But there have also been a lot of sales at still very low cap rates that haven't really been much of a discount. Yeah. Because they're like 1031s or whatever the case may be. So like there's still some like high prices.
I bet that there's some analysis, to use it generously, because I'm guessing that, the market's dominated by people that are holding their assets and not ones that are selling it at a 10% discount. Now, I think that it can be possible to acknowledge these declining valuations without running away from them completely. Now, whether they're right or not, or whether they're inaccurate, the fact of the matter is, like, people need to face facts and realize, like, well, with interest rates this high, prices got to go down.
Yeah, and that makes sense.
And I think that, like,
if and when the properties sell, which again, I think it's when we start seeing more sales volume, I think we can be more specific on this.
That's right.
The prices are. I think it's reasonable to say, they should be down relative to interest rates, though.
Yeah, and so my big question is, what kind of action can people take? I think gambling on rates to go lower or gambling on a rapid action by the Fed, that's going to be a bad bet outside of a dramatic economic crisis. And at that point, it might be a bet not a bet worth chasing, period. Because you've got a crisis to deal with. It doesn't really matter what rates are. My real big question here is how to prepare for a coming wave of loan maturities. What can investors actually do right now other than wait?
Yeah.
Do you kind of get your capital prepared and ready to strike? Do you start talking with syndicators that are waiting to pounce on these opportunities? What kind of actions can you do? Because I think that there are actions, and not acting isn't in itself an action.
Yeah.
But I think that there is a perspective and a frame of mind that you have to get in that's not just wait and see, sit on your hands. It's more like poised.
Yeah. Well, I can tell you what we're doing, Matt. I can't speak for all syndicators other than just observations of what people are doing and what could be happening. There's a lot of pushes and pulls and incentives in this industry for doing a deal and what we should do.
Mm-hmm.
What I think, what a sponsor should do, also LPs and investors in general, it's the same stance. And it's to take a very tight but aggressive posture of, you're not out of the market, you're not doing deals, but I think it is appropriate to increase your return criteria to a point where you are receiving an adequate premium on the risk you're taking. My perception is that there's more risk in the market today than there was a couple of years ago. Therefore, I need to be compensated. The way the macro environment looks and appears is an environment where I need to be compensated with cash flow. Just like we talked about the Newmark bullet point earlier, the return is going away from appreciation. When it was all about appreciation and cap rate compression, you could justify a low cash flow, mid single digits, low single digits even, because you're like, well, we're going to compress cap rates, we're going to get a big pop. Or we're going to do a big value add and we're going to get a big pop, which can still work in some cases. It's harder and harder to get the right price by the right deal, right opportunity. We don't have those luxuries of just the market working out in our favor. And so by buying on real in-place cash flow that we know is going to occur and having our return more weighted towards cash flow, that gives us a significant amount of, I guess, cushion is one way to call it. I call it like headroom. Because if something goes wrong, whether it's our fault or the market, whatever, there's a lot of wiggle room that we can kind of work around. So if we're not hitting our 10% cash on cash, but we're hitting 8%, we still have room. We still have a lot of headroom versus, I missed by 4% and now I'm at 2% or 1% or I'm at break even. It's much skinnier. So I'm setting my criteria where I'm getting an appropriate risk, a premium on the risk I'm taking. So like instead of hitting a 6% cash on cash out of the gate, I want to hit an 8% plus. Instead of averaging 8, I want to average 10. IRR is still around 15%. That doesn't really change. Shooting for like an IRR north of 15. So not accepting less than a 15. Where in the past couple of years, a solid 14 would get us. We feel okay, and a lot of groups would go down to 12. Things to look out for is FOMO. Especially from a syndicator and a sponsor, because there's so many incentives to do a deal. Now, an investor can have an incentive to do a deal because they got cash on the sideline, they're getting anxious and they want to pull the trigger on something. Everyone feels that. A syndicator feels that, or a sponsor feels that just from like, I want a deal. Sure, they want a deal. I want to do something. But they also don't really get paid unless they get a deal. And if they've got staff, they're thinking, how am I going to pay those salaries? How do I keep the lights on? And the way that we've been doing that, and what most groups do, is through deal fees, through acquisition fees. So you have to ask yourself, one, there's a FOMO of, I got to do a deal. I see someone else doing a deal. I got to get back in the market.
Yeah.
There's also like, I need the fees to put food on the table of my team.
Yeah.
And that can be a strong incentive to do the wrong deal.
Mm-hmm.
So I think not giving into FOMO and sticking to your guns, getting ready to do a deal when it is the right deal that makes sense, you're doing the due diligence, you go hard and aggressive at it when you're in your pursuit and execute the business plan. But it's not an environment to be taking, ringers and just hoping it works out and speculating on a lot of growth and like, hey, we know this is going to work because it's a good location, or this is a good market.
That's what I was just thinking.
We're gonna grow out of it. There's the whole idea of growing out of it. Will that happen in some cases? Like, absolutely. But I also guarantee the people who are going to get burned are the people whose plan was to grow out of it.
Yeah.
So again, you can take that stance of, I'm going to do a deal, we're going to grow out of it. But you just have to understand you're taking on more risk. And so, like, for example, I'm going to do it. Let's say, like, no, well, this doesn't apply to me because I'm doing value add deals. Like, I can use negative leverage because I'm doing value add. We're going to force the appreciate.
Yeah.
We're all doing that to a degree,
Yeah.
right? I'm going to buy a deep discount. And great. But the reality is a lot of these guys aren't even buying a deep discount.
Mm-hmm.
Putting a lot of money in may or may not be able to get that risk, or they may not be able to get the return on that renovation. Where in the past, someone else would come in and buy at a low cap rate because, like, oh, well, cap rates have compressed and I'll be able to do it again. But you're not going to get that buyer, within 2 years again.
Yeah.
Like that's what's gone away. And so where people have been saved, people recently, is they don't execute well in their value add plan. They still sell it and make a big pop.
Mm-hmm. So
you can not fail, but you can not achieve your value add like business plan and still have been a winner.
Yeah.
But now if it's you, not only you have to own the whole process and the results, you need to own the 5 years holding of a property after you've done the work.
Yeah.
You've done the work, you've renovated the units, now you're going to operate it.
Mm-hmm.
And it's that operating piece that's been missing. So be careful of the FOMO. Don't just do a deal because it's been a while since you've done a deal. We're getting calls from investors all the time, like, hey, when's your next deal coming out? Like, you don't want us just to do any deal.
Mm-hmm.
And you have, as a sponsor, you have to almost, look at your kind of top line revenue and what you want to hit. And obviously you got to be aware of it. You almost have to kind of brush it aside. You can't be thinking about that when you're looking about doing a deal.
Yeah.
You have, when you're looking at doing a deal, and this is the way I look at it, I do not look at the GP returns at all until we've already made a decision to do a deal. Then we've already got the structure, so we know kind of generally what it all looks like. But I'm looking at what the cash flow to LPs are, what all the return metrics, and I'm looking at it from an LP. And would I get excited to put money into it? Because I am going to put my own money in, and I'm going to get my friends and family. We're going to put money in. We're going to allocate capital into a deal that makes sense.
Yep.
And so it's like, is this deal a deal that we can get really excited about? I want to do deals I get excited about that are really good deals, and because I believe that by building a reputation on doing just like the best deals and having quality over quantity will eventually serve us better, because we can have a reputation of only doing high quality deals.
Yeah.
And I just, from a lot of groups that I really admire and respect, I see the machine, once the machine gets built, just the machine gets turned on, and it doesn't do a great job of discernment, especially as it grows and you've got a lot of stuff going on. Deals just get done to do deals.
Yeah.
And I've said this a ton of times to the team. You've heard me say a lot, Matt.
Mm-hmm.
Like when I brought on, Jay as first person we hired, literally the first thing I told him was, we're never going to do a deal just to do a deal.
Yeah.
And I remember that being the first thing I told him.
Mm-hmm. I mean, I think that in this, you got to look at these as investments. And I almost think that looking at it boring, something that may not be in a growing place, but just like a boring place a boring property that has cash flow, That might be a lot.
I want it to be growing.
Yeah.
That's the only where I would differ from you. But no, I agree. Places like it doesn't have to be sexy.
Yeah.
And like if you go at the sexier deals, like are rarely the ones that have like the great returns. And unless it's so sexy, unless you're banking on appreciation and you're banking on someone thinks it's sexier than you are, and you're waiting, it's a greater fool fallacy.
Yeah.
Whatever.
Yeah.
That's what you're relying on, which happens a lot.
Mm-hmm.
But if we acknowledge that maybe we're in a different environment, or we're at least going to be in a different environment for the next couple of years, well, that'll return like absolutely. And it's going to probably return within a couple of years, within 10 years, because these things always go through cycles. We're typically in a period of, a little over exuberance, even though we think things are bad, like things are usually better than they are. Like, poorly. Like there's more up days in the stock market than down days.
Mm-hmm.
It's a time to be cautious. And, if you missed the last week's episode on the Gray Report, go back and listen to that. And I don't think we've clipped it out yet, Matt, about our story about the investor.
Well, it's coming out today.
It's coming out today.
Yeah.
So check it out. About the investor who was talking to us, and they were talking to another syndicator, and they chose the other syndicator basically because we wouldn't promise them the moon and the stars.
Yeah.
End of the day. And you want to just be careful that you're not just looking for what you want to hear.
Yeah.
And it's more about aligning your goals and just the way you look at the economy and investing and just how you would handle money, or just a style that aligns with you. And so for the LP or the sponsor, just be thinking about FOMO.
Yeah. Yeah.
Because again, like we talked about this a lot, we've been this similar story of like prices don't make sense. It's hard to find deals. That's been going on for almost a year now, more than a year. Mm-hmm. And it's frustrating. If you've got money sitting on the sidelines, you want to get that to work. It's hard to get the money off to work. When is that go time?
Yeah.
And all of this being said, there is risk in inaction too, because your point, Matt, inaction is a choice in itself.
Mm-hmm.
Specifically, you're choosing to allocate those funds and assuming you're putting it in cash, into treasuries, rather than investing into apartments.
Yeah.
With treasuries yielding, maybe 5%, I think that makes sense.
Yeah.
So I would for now, for me, I would skip on the marginal deals. And again, if maybe there's a chance that those marginal deals end up being good deals and the market just goes up and everything is just, we just missed it, Matt. Mm-hmm. And it's like we're 2020 all over again. And people are waiting for the prices to just fall and drop, and they don't. They skyrocket.
Yeah.
The probability of that happening 2 times in a row without a correction within a 5-year period is possible, but I think statistically pretty improbable.
Yeah.
So I don't see as like we're gonna miss out on a potential ton of upside by sticking to our guns and really going off fundamentals. Now is the time to stick to fundamentals.
I wonder if a little bit of the sluggishness of the market and this kind of protracted hope that the market's going to get back is because people went through the pandemic, was like, well, look at all those people that sat on their hands during the pandemic and the market just did great. So it's going to do the same thing now. Well, but the interest rates are different.
But it's a different environment. I mean, we think about that too. I'm like, well, if we would have sat around during the whole pandemic, we would have lost out on tons of great opportunities. There are also people who bought, in 21 who were like, man, I'm glad they're not on the sideline anymore. And they put floating rate debt on and they thought that they were a genius.
Yeah.
And now they're looking at it and they're like, ooh, I messed up. So I think time gives us a little perspective on things. Well, Matt, these are excellent set of reports. Once again, hop over to sign up for the newsletter, though.
Yeah.
GrayCapitalLLC.com/newsletter. We appreciate you watching this video. Make sure you've given us a like and you're subscribed. That way you're going to get hooked into all the new content. We've got, I meant to mention this earlier, Matt, we've got a live webinar. YouTube Live. It's a webinar, but it's on YouTube. It's live on YouTube, but it's also a webinar.
Okay.
It's about this upcoming fascinating report on commercial real estate loan maturity, specifically multifamily, but a little bit of all commercial real estate. It's the first report of this kind that's being released by Gray Capital. It's going to be released June 7th, I believe.
Mm-hmm.
Is it gonna make news? Is it gonna break the news cycle? That's yet to be seen, but we're going to be doing a nice little YouTube live to cover it. And we're going to be talking about it on the Gray Report, I'm sure. So just stay tuned for that. We've got some events coming up. Just stay in touch with us. Follow us on the social medias. Leave a comment. We'll get back to you. We got to do that in the next episode. We got a couple of comments. We got to respond to people.
Okay. Yeah, totally.
We got to do that. Thanks again. Catch you in the next report.